Hello, this is Matt Beatty. I'm a PhD student at the Engineering College here at the University of Oklahoma, and today we're going to be talking about comparing the investments that you can make with real estate investment trusts and the housing market. One of the questions that we want to answer is real estate a good investment over time? Real estate has long been a popular investment choice in the United States. Owning a home is the American dream, and realizing a gain on that home is a way of creating wealth. But when we think about real estate in general, what's the best type of real estate to invest in? Would it be residential, such as housing, such as purchasing or owning a home? Could it be commercial, such as purchasing an office building, a strip mall, or some other form of commercial investment? And should we invest in it anyway? Is real estate really the right thing to do? And we're going to compare real estate as an investment choice against that of the market. So how can we invest in real estate? Well, the first way is that we could purchase a house. That would be residential real estate. So you can see here in this picture, this happy family's just purchased their new home, and those nice parents have signed up to work like dogs for the next 30 years to pay off the big mortgage they just got. Or we could purchase commercial real estate, such as buying an office building or a strip mall or something like that. But that's pretty expensive. So is there a way for us to gain the benefits of owning commercial real estate without having to sign up for a large sum of money? And the answer is yes. We can do that by investing in a real estate investment trust. So what is a real estate investment trust, or as I'll start referring to it here, a REIT anyway? Well, a REIT is a type of trust, almost like a corporation, where investors purchase shares in the corporation. The REIT uses the money provided to them by shareholders to make acquisitions or capital investments, and those assets have tenants that pay rental income or interest back to the REIT, and then the REIT distributes the rental income back to the investors in the form of dividends. Now, there's a couple interesting things about REITs. First is that the asset doesn't have to be what you might normally think of as a real estate investment. It doesn't have to be a building. It could be, for example, a housing development, a set of buildings. But what's even more common lately is it could be a cell tower, or it could be a data center. Basically, anything where you can have somebody that's willing to pay for space and pay that money to a landlord is an asset that could be owned by a REIT. Now, there's a couple other things that are unique to REITs. The dividends that are paid to the investors are actually subject to tax, unlike ordinary dividends from a normal company where those dividends are tax protected. So why would somebody invest in a REIT? Well, proponents of REITs would tell you that a REIT enables a small investor to enjoy the benefits of owning real estate without the large capital outlay required to purchase real estate. So you can see this quote here from NAREIT, who is essentially a real estate advocacy group for the industry. And you can see what they're claiming here. They're claiming that REITs have competitive returns, they provide steady dividend income, and they can diversify a portfolio. So what we're going to do is we're going to compare housing, REITs, and the stock market from the period of 2005 to 2020. The reason that we're looking at this period of time is that it includes the recent long-term historic bull run that we've had in the market from around 2011-ish to 2020. And it also includes the Great Recession from 2008 to 2009, where all types of investments tanked during that recession. And then finally, we go back just prior to the Great Recession, where there was a run-up in the market going into 2008. So we're going to use three assets to take a look at the value of these investments. We're going to use the Federal Housing Finance Agency's House Price Index as a barometer for house prices. So for example, if I was to buy a house and see a gain in that, then my gain would be the increase in the price of the house. The house price index is indexed to 1991, January 1991, which would stand for 100. And then pricing of the average house price after 1991 is essentially like a multiple of that. So for example, if the housing prices in 1992 were twice as high as they were in 1991, the value of the index at that period of time would be 200 versus the 100 in 1991. There is an index that takes into account the value of REITs put out by MSCI, and the REIT index takes into account the gain in the share prices of the REITs. It also takes into account any potential stock splits, and it takes into account, most importantly for a REIT, dividend income. And then finally, we're going to measure those two indices against the third index, the index for the market, the S&P 500. We'll be looking at three different ways to compare these. First, we'll take a look at simple statistics. We'll just say, well, what were the mean monthly returns for each one of the investments? What were the cumulative returns over that period of time? And how volatile were each of the investments? Then we're going to get into the calculation of the parameters of the CAPM model. So we're going to calculate alpha and beta for the MSCI and HPI indices, and we'll use the S&P 500 as a basis for that calculation. Then finally, we're going to take a look at creating a factor model and determining factor prices according to the arbitrage pricing theory. And then we will sum things up and try and decide, well, is real estate a good investment? So let's start off with the simple statistics. We can see that the S&P 500 actually had the highest average monthly returns. Their peak is right about here. A REIT peak is right about here, and housing is right about here. And it's kind of hard the way they're clustered together to see the difference, but the S&P 500 did have the highest average monthly returns, and housing is the least volatile investment. So housing, the orange line here, you can see the spread in the orange line, very narrow. So not a lot of fluctuation in the gains provided by housing compared to the S&P 500, which of course is more volatile, has more widely dispersed more widely dispersed monthly gains, and then REITs, which were highly volatile compared to the two investment types. So over the course of time, from 2010 through 2020, REITs had a total cumulative return of 74%. Well, not bad. So if you put $1 into a REIT in 2005, then you'd see a 74% gain on that dollar if you held on to it until January 2020. Housing, on the other hand, think of this as, so we're talking about housing as opposed to commercial real estate, only had a cumulative return of 42%. So right away we say, aha, it seems like REITs had a higher cumulative gain, but we did have to live with substantially more risk. And then the S&P 500 outpaced them both to quite a degree. It had a cumulative return of 161% over that period of time. When we plot the monthly and cumulative returns as time series, we get a little bit better feeling for what's going on with these three assets. You can see that for the month-over-month returns, we see that the orange line, housing, is again very small, very steady. And we see that, on the other hand, REITs and the S&P 500 have a lot more fluctuation, and REITs in particular during the Great Recession fluctuated greatly compared to the S&P 500. When we look at a comparison of cumulative returns, we can kind of see an interesting pattern here where we see REITs were outpacing both investments in the run-up to the recession. They did see some declines going into the recession, and then they cratered to a greater degree than the market did. Housing didn't see as much of a dip, but it certainly did see a dip. And then after the recession, what we saw the S&P greatly outpace both REITs and housing. Now, something interesting has happened to REITs in this period of time here. The nature of the investment in REITs has shifted a little bit more towards technology REITs, where cell towers and data center storage space and co-location space became a bigger portion of the overall REIT market. So maybe that changed the dynamic a little bit. When we turn to the CAPM model, we take a look at both the REITs and the housing price index. And we can see that for REITs, there was a negative alpha value of minus 0.0016. This means that the REITs underperformed what we would expect for a return on them based upon the risk carried by a REIT. And the beta for REITs was very high at 1.28, which means that as the market moved, the REITs moved, but they moved to a greater degree, which calls into question the claim that REITs provide good diversification in a portfolio, especially one that's heavily weighted in the market. Housing, on the other hand, had a smaller negative alpha, but nevertheless it was negative, which would say that for the risk associated with housing, even though it was very small, the very small return associated with housing was not what we would expect. But the beta associated with housing, very small. So as the market moved, housing prices don't move nearly to the same extent, which is what we saw in the previous charts. We then look to construct a factor model where we model the return of investment as a function of a constant, which in this case is our risk-free rate of return, plus parameters B for the investment I, multiplied by an economic factor J, plus an error term. We looked at several different factors to include in this model to predict the return associated with REITs and housing. We chose the month-over-month change in gross domestic product. We chose the change in consumer price index, chose the change in U.S. unemployment, the change in the S&P 500 index, the corporate tax rate, which just recently changed for the first time in many years, dropping from 35% down into, I think it was 25 or 24. And then finally, the monthly yield of the risk-free asset, which would, in this case, we use as the 10-year U.S. government bond. We then take these factors, multiply them times the B parameters, and try and figure out, well, we calculate the B parameters from this model, and then we take those B parameters and use them to calculate lambda for the arbitrage pricing theory model. So let's see how we did. Well, not so great. Unfortunately, our factor model fit the data poorly, and our arbitrage pricing theory model was essentially of no value, and that was in large part, we believe, due to the fact that we were only using two assets to calculate the lambdas. So when we looked at the factor model, the R-square for the REIT model was 0.577, below what we would have hoped to have seen. The HPI factor model was even worse at 0.287. And the arbitrage pricing theory model, the R-square for that model was 0.005, which essentially says that a random set of data could have just as easily have fit that model as the data set that we had. Now, one more note to make on that APT model, we had several different factors, and so we're doing a least squares linear regression fit in multidimensional space using only two assets. So if you think about it, we could have many, many different shapes of a curve that would fit within that model and come up with the same minimum least squares amount. So we're not terribly surprised what happened here. But when we look at the B factors anyway, even though our models didn't perform to the degree that we would like them to, we can still take a look just out of interest and see what our B parameters look like. And you can see that for REITs, there is a pretty high factor or pretty high parameter associated with the change in the S&P 500. GSPC is the symbol for the S&P 500, where we see that it was almost 1.28, and there was also pretty high B factors for the change in CPI and the change in gross domestic product. Again, we don't really want to look too much into that because you can see the probability that random data could have generated the same parameter value is very high in these two cases, although it was pretty low for the first one, which again follows everything that we've seen, where a change in the S&P 500 is kind of mirrored by a change in REITs, and this B factor is almost equivalent to the beta that we calculated earlier. For housing, again, model wasn't of terribly much value, but you do see a lot of certainty around the factors associated with consumer price index and GDP, and this kind of is one of those common sense things. So although the cost of housing is not included in CPI, that's rents are included in CPI, you would expect there to be a pretty high correlation with rental costs and the cost of owning a home. And housing, because it represents such a large proportion of GDP, well, you would expect there to be a pretty strong relationship there. But again, overall, we can't really draw any strong conclusions there, but we can kind of surmise as the model got tighter and better, if we chose our factors better, we might see a little bit more evolution along these kind of lines. So what do we conclude? Well, first, we conclude that the market, as measured by the S&P 500, performed significantly better than REITs or housing from 2005 to 2020, a period which included both the recession and a historic expansion. REITs did not, over that course of time, provide the diversification that you would want. In fact, they exacerbated the movement of the market. So if I was to rewind time and go back to an investor and she asked me if investing in a REIT was a good idea in 2007, and she was hoping that it would offset major moves in the S&P 500, then we would tell her, with the benefit of looking backwards, absolutely don't do that because you're going to lose everything. And then finally, we asked the question, well, maybe REITs have become less volatile because of the different mix of companies that are now making them up. Well, unfortunately, what we're seeing here is we're seeing history repeat itself in the COVID contraction, where let's look at right here. So here's when the market cratered due to COVID. And this line, the one that was greater, were REITs once again. So they went further down than the S&P 500 did, and they've come up to a similar pace. But as a result, the contraction of the market would hurt REIT investors much more than it would hurt investors in the regular market. So again, if you can't diversify against a major contraction, then what is the value of the investment? So this would suggest that you have to be careful if you're going to choose REITs as an investment vehicle, and that choosing the general REIT market might not be a good idea. So I might not want to invest in, say, Simon Properties, which are a malls company, and I might instead focus on pure technology REIT, like investing in Equinix, which is a data center provider who probably sees a little bit less risk associated with a major contraction like this. So thank you very much for your attention, and I hope you found this informative.